At SL Advisors, we talk to clients and prospects all the time. Some questions come up regularly, and we thought it would be useful to provide some answers. So here are some recent questions and how we typically respond. Why is energy thought to be out of favor at the moment? Energy is a cyclical business. The sector peaked in 2014 with the shale revolution. As in other cycle peaks, rising oil prices encouraged overinvestment. This was true of midstream pipeline companies as well as the E&P companies that drill for oil and gas. Too much capital was poorly invested and didn't generate high enough returns to cover the cost of capital. At the same time, concerns about climate change and the energy transition were making some investors worry about stranded assets, oil and gas that would never be extracted, pipelines that would be unneeded and out of service before their time. And then you had COVID, which led to a brief but sharp collapse in energy demand. These three headwinds hurt returns and left the energy sector out of favor. The good news is they've all turned around. Improved capital discipline means companies are more stringent about the projects they finance. The energy transition is understood to take decades and require today's reliable energy for a very long time. And COVID is over. The investors dismissing energy today are still hung up on these old concerns and not yet recognizing today's reality. Why are energy stock prices correlated with the price of oil? It's a common misperception that oil prices and pipeline stocks move together. It makes sense for ExxonMobil to respond to oil because their profits depend on the prices they get for the oil and gas they produce. It makes less sense for pipeline companies to have the same sensitivity because they operate what we call a toll model. This means they charge a fee to move, store, or handle hydrocarbons. They don't care about prices as much as volumes. During market extremes like COVID, oil prices fell because the market anticipated lower demand, which means lower volumes passing through pipelines. But that's not usually the case. The volumes of energy we consume in America are remarkably stable from year to year. Prices move much more than volumes. And if you examine the data carefully, which we have, it turns out that over the long run there isn't much of a relationship between pipeline stocks and oil, and there's no relationship at all with natural gas. It's just at the extremes that they become more linked. Now that leverage has come down from around 4.5 times debt to EBITDA to below 3.5 times, we think you'll see even less of a connection between commodity prices and pipeline stocks. Is it a good time to invest in energy? I was burned in the past. We definitely think so. Companies are spending less than before on new projects. There's greater financial discipline than in the past. Leverage is coming down. Dividend yields of over 6% are comfortably covered by free cash flow. This is enabling companies to buy back stock as well as increase dividends. And energy demand is rising globally, especially in developing countries. The midstream sector has solid foundations, and the cautious approach shown by many investors makes this a good time to invest in the sector. If you're interested in learning more about the energy sector and interest rates, then don't forget to subscribe and follow us on LinkedIn and Twitter. Our handles are in the description box below. To find out more about what we're thinking, you can sign up for our twice-weekly blog at sl-advisors.com. We always love to hear from you. So if you have any comments or blog ideas, please leave them down below. I'm Simon Lack. Thank you for watching this video.